Welcome everyone. Today's video is going to be about the correct way to read market structure. As you know, if you're a beginner trader or you're new to trading or you've been trading for a while, you know that the most common ways to interpret where trend is going or to know where trend is headed is by drawing these higher highs, higher lows, and if another higher high is formed after a higher low, that's an uptrend, and vice versa. And if we have equal highs, etc., the market is ranging. Or there is the more fancy way, the more trendy way, especially the ICT, the SMC concept way, where we have to look for a break of structure to confirm continuation of trend, and yeah, so or the market structure shift, etc. But in reality, once you take these concepts to the real market or you try to apply them, you're met with this. You look at the market, it's not that simple. It doesn't look like these uh, easily drawn sketches over here. You try to do the same. So you try to mark up the higher highs, the higher lows, you get wicked out. The market changes. This is the 1 hour chart. You try to do on the 15-minute chart, the 4 hour chart. It's messy and it's not a reliable way to consistently pull money out of the market. Doing this, in my opinion, has no edge, and it's very naive of you to think it's that easy to win money from the market just by throwing a bunch of shapes, etc. In my opinion, is very naive, and even if you win a trade here and there, you will not have a level of consistency. So what do professional traders use? The ones that work in hedge funds, banks, financial institutions, how do they look at market structure and what do they use? This is going to completely change the way you trade. So I hope you follow this video very closely. So they, instead of looking at candles, they look at volume. Volume is way more important than candlesticks, because what does a candlestick give you? A candlestick give you 4 points of data. It gives you the open, the close, the high, and the low. So that's not enough to have an edge in these financial markets. They are very competitive. That's not enough to have an edge. You need a better way, a more efficient way that's not affected by fractality. So if you don't know what fractality is, basically it's like when you change the time frame, the candles change. Excuse me. So if I go to the 30 minutes or whatever, excuse me, the candlesticks, they change. So if you're looking at a break of structure, for example, in the 30 minutes, it's probably not gonna be there in a higher time frame or etc. So that's fractality over there. The lower the higher time frame you go to, the price is completely like the market structure completely changes. But if you look at volume, volume simply put just analyzes these indicators called the volume profile. If you're wondering, it just analyzes the transactions that happened in a price point. So for example, as you can see here, when the volume is low, it tells you, yo, there isn't a lot. So there isn't a lot of transactions happening here. But when the market goes left and right, that means buyers and sellers, buy, sells, buy, sells. Buyers and sellers are buying and selling in bulk. It draws this yellow line over here, which is called the point of control. This basically means the highest traded volume in a session. And look at this level. It just becomes a very important support where price just taps it and just flies, because buyers and sellers were trading here the whole day. You see that? But this is beside the point. What we're here for is how to read market structure, and the way we can use volume to read market structure is to look at volume imbalances. The concept behind volume analysis and market structure is when we have a volume profile that of a different session opening above another volume profile, it shows us that there is a money shift in the market, that the money shifted from trading from these price levels over here, and it thinks these levels are unfair to trade at and the price should go up. So basically you're just reacting to the big players, and you should position yourself with them, not trade against them. Okay, so the moment you see an imbalance in volume, there is a huge imbalance in volume over here. This gives us the bias that we should be looking for buys. And if you can see here, if you consistently looked for sells here, you would have got burned. And look at here again. There is another excuse me, let me look. There is another imbalance here as well. There is another imbalance here that I forgot to mention. But look, there is another imbalance, and now prices are just going down because there was an imbalance to the downside. The volume opened below another volume profile, and this tells us, okay, buyers and sellers, they don't agree that these prices are fair, so they're gonna push the price down. And over here you can see that the volumes are opening next to each other, which tells us that there is some indecisiveness in the market. So this is a ranging market, we should stay away from it. And if you have some range trading strategies, you would have made a lot of money. But the moment another imbalance happens, you sell. And over here as well, you can see if we open another profile, it's probably gonna be up here. It's gonna look like this, and it's gonna draw an imbalance here, and we just ride the trend up. Do you see that? This is the correct way to look at the market structure. It's easier, it's less stressful, it's less complicated. It doesn't get affected by you changing the time frame, because if you change the time frame or not, buyers and sellers are gonna stay at the same levels. It's not like there is different buyers in the 15-minute and the buyers are gonna be different in the 1 hour, etc. It's like if buyers and sellers bought and sold, you can change the time frame as much as you want to whatever time frame you want. It's still gonna be the same prices, the same outcome. That's why I recommend you do not analyze candlesticks and you actually start analyzing volume. Of course, this is a very simplified way of looking at it. I go in depth. I have a Discord where I go very in depth about this stuff, and I teach people about this stuff. If you want to check it out, it's a free Discord. Post 3 analysts on there as well. To close up this video, I would love to share something with you. One sec. These are my recent results. I hate to do this, but a lot of people only watch videos from people that actually have results. So as you can see here, these are my FTMO account stats. You can see in 4 months, you can see there is a level of consistency there. That I've been winning money consistently for 4 months. And yeah, this is a monthly P&L. You can see some of the positions, and I'm gonna show you some broker withdrawals. Nothing too crazy. This is live, so I trade live, funded, etc. But this means nothing because this can be fake. You're probably watching this. This can easily be fake. But I'm not telling you to believe anything that I'm saying. Just join my Discord, see what I post, look at the free analysis. Free value is being given every day on the Discord. I wish you guys the best in your trading, and see you in the next video.